Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a quick look at Crocs Inc. What is going on with the stock today? It is down about 7%. They just had their earnings call. It was very mixed. Good Q3 results, but guidance going forward is very mediocre. So the stock is down quite a bit. Started at 75 and rose up quite a bit. I think at 75 I would have been a buyer. At 81 maybe not, but I will take a quick look. I did do a longer video about this stock a couple of weeks ago. I will link it down below where I talk more about the business. But all you need to know is that they make weird, quirky, somewhat ugly shoes and have $4 billion in annual revenue somehow. They grew quite a ton during the pandemic, and that's reflected in their stock price since then. This was a $20 stock, maybe a $30 stock pre-pandemic, soared all the way to 180, then fell really quickly as questions arose about their growth, then rose again after they acquired Hey Dude and growth returned a little bit, and now is falling again as growth is starting to fall down. Hey Dude was a brand they acquired for about 2.1 billion sometime around 2021, and now growth on that brand is slowing and questions are arising whether that was a good acquisition. Crocs continues to be a source of strength for them. 800 million in revenue for the quarter, up 11%. Asia is doing really well. North America is still doing pretty well. Direct to consumer sales are solid. Hey Dude is struggling, down 9% already, quickly after an acquisition. This is a brand that was supposed to be a source of strength for them, obviously is struggling. A lot of that is due to the wholesale channels, and I'll talk about that in a second. They did take on some debt to acquire Hey Dude, but they're paying that down pretty quickly. At the end of the day, this is a company that is free cash flow positive in quite a decent way, and they're able to pay down debt. They're already down to 1.7x gross leverage with a target of 1.5x or below, which they should get to pretty quickly. They are starting to repurchase shares again. They repurchased 150 million of shares. I think the purchase price was somewhere in the low 100s. Now the stock is at 81, but they still have another 900 million or so authorized. Operating margins are up. Diluted EPS is up. Solid returns. Again, they make shoes. Some say they're ugly. Others say they're sort of ugly. Who knows exactly why people like them, but they do. They're pretty comfortable. They're not too expensive. Their sandals are doing well, growing at a pretty decent clip, but growth is slowing there at all. But this is a pretty big global category that they are focusing on, and they're kind of expanding their Crocs portfolio to ugly shoes like this one, and also ugly shoes like this one, and also ugly shoes like this one. So a lot of ugly shoes that are selling pretty well, because who doesn't want some Shrek shoes? I certainly do. I don't own them, but you know what I mean. And then as you go to Hey Dude, these are more like regular type shoes. They thought they were going to push them into a new area, allow them to explore other parts of the shoe business. And this is not a horrible acquisition. At the end of the day, it was a 2.1 billion. Since the acquisition, they've already made something like 400 million in EBIT since they acquired them on this brand alone. But the brand is slowing. And I think what they're doing, they're saying it's a strategic move. They are reducing some of their wholesale partners. They specifically mentioned some in Europe, some in Africa. One call out was a wholesale partner in Africa that is worth about 29 million, was it 39 million? One of those numbers in 2023 revenue that they canceled their account with because they found that some of those distributed shoes were ending up on Amazon with the gray market, and that was cutting into their margins and their sales on the direct to consumer side. They also talked about the gray market in general, how in the past they were matching gray market sales. And if you're not familiar with the gray market is, it's basically third parties selling original Crocs on a website that Crocs also sells directly to consumers. So if they're listing Crocs at $29 and Crocs is listing them on Amazon at $39, it's tough for them to compete. Well, in the past, they would match prices. In going forward, they're essentially saying we're not going to match prices anymore. We're going to list at whole price. We're going to hope that our brand sell through is there. And at the end of the day, we're going to reduce the number of gray market items, which might put pressure on revenue growth in the short term, even on the Crocs side. But in the long term, it should be beneficial to Crocs. That's kind of what they're doing, why they're rationalizing removing some of these accounts, because they're not really working for them. So at the end of the day, gross margins are going up, operating margins are down a bit, adjusted operating margins are up, adjusted diluted EPS is up. This is still a brand that is primarily driven by Crocs. Hey Dude is a small portion, but it is 25%. And if 25% of your business is shrinking at 9% when it was supposed to be growing for a while. That's a bit of a problem. Still primarily focused in North America, but like I said, Asia Pacific is growing really, really well. And that wholesale mix is about 50-50 with direct to consumer. You can kind of see Crocs doing really well, whether it's sandals, whether it's gibbets, the little things you can put into your Crocs, whether it's clogs, growing at a solid clip, mostly in Asia Pacific. That's really driving their overall growth. Thank God it's there. If you look at Hey Dude, direct to consumer is solid, but wholesale is a good portion of that business, and it's shrinking quite a bit. And some of that is driven by the fact that basically wholesale partners bought a bunch of these shoes thinking they were going to sell really well. And from my understanding, they're just not selling as well as they hoped to, as they hoped they would sell. Those are the words of the retail partners. They're also cutting back on some retail partners as well, trying to sort of make sure that they're not diluting the brand by offering them to stores where they're just sitting on shelves. They're also probably getting some of those shoes back from wholesale partners where they're just not seeing the sales that those wholesale partners expected, and that's not really a good thing. It's a bit of a problem because that is not going to be just a Q3 phenomenon. To me, that tells me that, you know, I think Crocs' idea was that they would push these shoes out into the marketplace, really grow the brand really quickly, get them into as many stores as possible. And the retail partners were willing to take those on, but the sales just aren't there in a lot of areas. Is this a fad? Is it not? Shoes can come and go. Allbirds is a good example of this. They were really popular for a while. You could not get them even at whole prices. All sorts of calls were sold out. Now I'm getting emails that they're down, 70%, and I'm not buying them. So brands can come and go. I mean, Crocs seems to have staying power. Does Hey Dude? It's really a question mark at this point because they're down 8.5%, and a lot of that is driven by the wholesale market. The direct-to-consumer market is up, but I also saw a lot of discounting. I do, for whatever reason, get Hey Dude emails. I must have gone to their website or signed up for something. And there's a lot of discounting on the direct-to-consumer side as well. So I think the brand is struggling a little bit, and that's a concern, especially when margins are falling alongside revenue. Luckily, Crocs margins are going up, which is really holding up this business as a whole. Again, Crocs adjusted operating margins are up 430 basis points. But Hey Dude, despite slowing growth, they're down over 900 basis points on the operating margin side. So they're discounting, but that discounting is not leading to actual growth on the revenue side, which is a bit of a problem. You can kind of see their net leverage. I'm not really worried about their capital allocation. I think they're going to buy back shares. Not that the price is lower. They're going to deleverage a little bit more into the next couple of quarters, but they're in a good position. The inventory looks pretty good. Looks like their inventory going into Q4, which is a pretty good sales quarter for them, is relatively healthy. They're not overproducing, which is a good thing. But it also shows that there isn't a ton of demand for their Hey Dude product because their inventory is relatively low. They know that there's not going to be a ton of demand, and they're showing that in their guidance for the rest of the year. The expectations, and this is probably why the stock is down as much as it is, the expectations were 12.5 to 14.5% growth. Now they're going to achieve 10 to 11% growth. Operating margins are going to drop a little bit, probably more investments into CapEx, not CapEx, rather, more investments on the Hey Dude side to do whatever it is they're doing there. One-time costs are going up a little bit. But at the end of the day, the main problem here is Hey Dude was expected to grow 3.5 to 7.5%. It is growing -4 to 6%. So that is what is bringing this business down. Crocs is still going to grow what it was expected to grow, but Hey Dude is actually shrinking already, which is a bit of a problem. As you look at Q4, and this is what's driving it, right? You're expecting -20 to -25% growth on Hey Dude. That is terrible. A lot of that is blamed on the wholesale channels, the wholesale partners just not buying a lot of these shoes because the demand isn't there. Doesn't look very good. Crocs continues to be solid, but now the whole thesis here was, is this a fad? Is this going to start slowing down in terms of growth? Well, that's starting to play out, and a lot of that is driven by Hey Dude, right? You're seeing negative growth for the first time in quite some time. Crocs is still growing, but Hey Dude, which is 25% of the business, is bringing that ship way down. And they talked about that continuing into Q1 2024, continuing into Q2 2024. So as I'm looking out into 2024, can I really expect actual growth going into 2024 for the entire business? Or is this going to mean that growth is really going to slow down when Hey Dude pushes that growth pattern way down? So as I look at the estimates that we had for this stock, the estimates that the analysts had for this stock, 12.6%, not going to happen. It's down to 10 to 11%. 6.7% for 24. Well, with Q4 shrinking 1 to 4%, and potentially that same pattern happening in Q1 and Q2 of 2024 when it comes to Hey Dude growth, can this actually grow at a 6.7% clip? I think the answer is no. So as I look at my financials here, again, this is a $5 billion stock, $2 billion in debt or so. The market's giving it about a 10% free cash flow yield multiple. So it's a 10x multiple, essentially a 10% free cash flow yield. That's based on 2022 actuals. 23 estimates are actually going to be a bit better. I don't think they're going to grow much, if at all, for 2024. That's kind of what I'm assuming. Again, I think these estimates are going to come down going into the next couple of weeks. I wouldn't be surprised if you basically see flat growth in 2024. They're going to give more guidance on that in Q1, in the Q1 earnings call. So maybe I'm being a bit more pessimistic than I need to be. Initially, I had this at a -2 because when you think about some of the verbiage that was shared on a variety of calls this year, there's a slowdown in consumer spend on the retail side. And this is discretionary spend at the end of the day. People are not going to be buying Crocs if they're struggling. If Main Street is struggling, they're not going to be like, let's go buy some Hey Dudes, let's go buy some Crocs. It's discretionary spend is going to be impacted in a big way by a recession. And this isn't even probably pricing in a real straight out recession. This is just pricing in a little bit of a slowdown. So I think a 0% growth for 2024 is basically just a slowdown in Hey Dude sales and maybe a slight recovery by the end of the year. I still expect Crocs to continue to grow. Crocs, the shoe, not the overall stock. But Hey Dude is going to be an overhang that is going to impact overall growth. And since it's a lower margin business, it's going to potentially be an overhang on the bottom line as well. Now, they talked about trying to improve margins across the board. There's going to be less price reductions. Again, they're not going to price match the gray market. They're not going to be selling as many. They're not going to be having as many sales, et cetera, et cetera, et cetera. But I think the growth of this stock is now a question mark, whereas a couple of months ago, it really wasn't, right? A couple of months ago, people were probably penciling at 6 to 7% growth for the next couple of years. I'm probably thinking that this is going to be close to where it tops out. Because Hey Dude, I don't think is an amazing brand at the end of the day. I think Crocs is a good brand. I think Hey Dude isn't an amazing brand. And while I think I could be surprised, I could also see this be the starting point of the downfall of that brand. 25% reduction in revenue is absolutely disgusting. It shows that the demand for this product is falling off a cliff. They can say whatever they want about wholesale partners and partnering with the right strategic suppliers, but at the end of the day, the suppliers don't want this shoe. And sure, you can sell the direct-to-consumer growth as much as you want, but at the end of the day, overall growth is down 25%, and that is bad. That is bad. Doesn't mean that it can't recover, but I think if they were wanting this to be a $1 billion brand ASAP, it's going to take a while to get there, and it's probably a lot less than they expected from this brand when they acquired it for $2.1 billion. So they probably overspent, is what I'm saying. So I'm being realistic here. I'm saying no growth in 24 and then maybe 3 to 2% growth for the next couple of years. Maybe that's a bit pessimistic, but it is what it is. I'm assuming some improvement on margins. The margin base may be a bit pessimistic. I could see their margins improve much more than I'm showing here. I could see free cash flow margins in the higher teens, which could potentially show significant upside. As I look at the scenarios here, right now the stock is being priced to a 10% yield off of 2022 actuals, closer to 12% off of 2023 estimates. I'm saying the right number is kind of in that 8.2% range, kind of a scenario that's mostly weighted in the 8% range. You could be more pessimistic about this if you go higher. The fair value could go a bit lower. If I'm looking at a 15% return based off of these numbers, I'm kind of penciling in about a 14% return, expected return from here. So I talked a lot of negative things about this stock. And there are some negative aspects of it. But at the end of the day, the Crocs shoe itself is still very solid, very high margin. There's some risks here. There's third-party sellers. There's ripoffs on Amazon. Their patents are kind of expiring. Others can make what they make, but they don't have the manufacturing expertise that Crocs has. They can't hit the same margins that Crocs can. It's just a brand name, the Gibbets thing. People like, kids like it. They're comfortable shoes. They're not super expensive, which means that people can still afford them even during tough economic times. If a recession does happen, I still think there's certainly a lot of negative impact here, but I'm just trying to be realistic about what I know today. Do I think this stock can go lower? Sure. If I look at a 15% target return and the idea that, well, maybe the market is giving it the right multiple. Maybe this stock has to be at a 10% multiple. The fair value there is about $65, which is 20% lower than it is today. The fair value based on the assumptions I'm making is at $78, which is close to where it's priced at today. And the nice thing about this stock, and kind of what I talked about before, is that the market is valuing this as if it's a dying brand, as if it's going to fall off a cliff. And there's certainly the risk of that. If you tell me 5 years from now, Crocs is a $1 to $2 billion brand, would I be like, I do not believe you, that's outrageous? No, there's still a possibility of that, which is why I would never make this a huge position. But I think if it continues to kind of be steady, even if it continues to be steady, the returns here can be relatively substantial. They generate significant cash flow. I'm assuming some buybacks. That buyback yield, depending on valuation, could be as high as 4 to 5% at today's valuation, 2 to 4% at better valuation. So you're going to get a buyback yield. Even if you're getting relatively low growth, you could just kind of generate a 7 to 8% return just from buybacks and 2 to 3% growth, because their buybacks could potentially be higher than this, especially if their stock price keeps falling. The debt isn't too bad. They are free cash flow generative. They're going to pay back that debt pretty quickly. Could there be more acquisitions in the future? Yes. Hopefully they're better than Hey Dude. So if I look at this, even as I look at a 12% yield, let me just toss that in there. It's still a 7% return from today's prices based on a 2.5% return on just low growth and then a 4.5% buyback yield. So the downside, if it doesn't fall off a cliff, is relatively limited. The upside is if they somehow get back to growth, if they can really work on their margins and get it into the high teens, could be relatively huge, right? If they get to growth and the market reevaluates this and gives it even a 5 to 6% yield, you're talking about 20% plus returns, right? That's kind of where the thesis comes into play here. The thesis here is the market values this as a piece of crap. It's not really a piece of crap, but the risk is that the market values this as if this is a fad. And if this is a fad, this could, be a huge loser for you. But if it's not a fad, the return could be really, really good, really, really amazing even, talking 20, 30, 40% annually for the next couple of years. But for that to happen, they need to figure out, hey, dude, they need to get back to at least mid to high single-digit growth. They need to get margin expansion in the next couple of years. And I don't think that's unrealistic. I just think that we need more information as investors to figure that out. So for me, I might buy a bit more if it drops closer to, maybe if I get a 10% margin safety here in that 70 to 75 range, I would start picking up a bit more shares, maybe even in that $78 range, but it would be very small incremental purchases, because I think this is a stock that if there's a little bit of a correction, it's going to keep falling. There's going to be at least 1 or 2 quarters of mediocre results, I think, because of what's going on with Hey Dude. And I don't think that's perfectly clear in the earnings results yet, but it is kind of clear based on what they said in the earnings call. So keep that in mind. I think you might have time to accumulate I think I might have time to accumulate, so I'm not in a rush to buy this, because if this stock is in the 60s, in the 50s, in a couple of months, would I be super surprised? No. But if they can start picking up the pieces and really start growing again, this could move quickly in the other direction as well. So this is one of those stocks that's going to be very volatile, but I just don't think it's something that I need to rush to get into right away because of what's going on with Hey Dude and the question marks around that company, that acquisition rather, and that brand. So as always, guys, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. Let me know what you think about Crocs, ticker CROX. Like the video, subscribe. If you want to have fun with this spreadsheet, hit file, make a copy. I will share the link to the spreadsheet down below. Again, this is a tough one to price because the valuation looks really good on paper, but I think the metrics that you're seeing, the growth that is ahead, is so murky because of what's going on with Hey Dude. Anytime you see a brand that was just acquired shrinking at 25%, that should give you pause. And it certainly gives me pause. Now, I might acquire a bit more shares. I own, I think, like I said, 5 shares. So once it drops below 75, would I pick up more shares? Yes. Would I make this a huge position? Probably not, because this is a value play, but it could also be a pretty big turd if Hey Dude continues sinking the ship. Even though I like Crocs, the brand, I think Hey Dude right now looks really, really bad, and that's tough to forget when it makes up a quarter of the revenue. So like, subscribe, have a good rest of your day. Bye.